Assalamu alaikum. Hi guys, this is me Irfan Haider and you are watching my YouTube channel Irfan Haider Gilani. The topic which I selected for today's discussion, that is fiscal policy of Pakistan. I know most of the students have a confusion about the fiscal policy and the monetary policy. They could not make the difference between these two policies, so I decided to discuss the fiscal policy for today's video. In this video, we will see that what is the fiscal policy and what are these tools to influence the fiscal policy which government use, and who make the fiscal policy, and who are the ultimate final respondent of the fiscal policy. So let's begin the topic. First of all, fiscal policy of Pakistan, we will see the difference between the fiscal policy and the monetary policy. If we can't make this difference between these two policies, then it's mean we are in a gap. The monetary policy refer to the central bank activities that are direct toward influencing the quantity of the money and the credit in an economy. By contrast, fiscal policy refer to the government's decision about taxation and spending. So it is clear from this paragraph that the monetary policy is designed by the central bank of the country, and the main objective of the monetary policy is to control the circulation of money in the country and the credit in the country. How can they control circulation of money and credit? It is another topic, but today we will discuss only the fiscal policy. In the last two lines, he said that fiscal policy is the government's decision that how they collect revenue and how they spend the revenue for their country. So basically, fiscal policy is designed by the government for two points. First of all, how they collect and how they spend. How does it work? Monetary policy. When policymaker wants to influence the economy, they mainly have the LCD is broken. Okay, they mainly have to their disposal: monetary policy and the fiscal policy. Okay, the monetary policy is regulated by the central bank, and money supply in the market is adjusted by tweaking the interest rate, bank reserve rate, sale and purchase of the government securities and foreign exchange. So what does it mean? How monetary policy works? How monetary policy can control the circulation of money in the country? Let's suppose government wants that there are lots of money circulation, note paper in the country, and how can we control it? Government decide, or it means central bank decide that increase the interest rate on savings. When they increase the interest rate on savings, people come to saving and they invest their amount into the banks for interest purpose, for profit purpose. So it's mean they take action, government take action to control the circulation of the money in the country. How? To increase the interest rate. On the other hand, when government check that there is lots of circulation, there is less circulation in the money, there is no money in the country, then central bank decrease the rate of the interest. Automatically investors withdraw their money from the banks and use this money into the investment in the country for different businesses. So this is the simple example of how central bank control the money circulation in the country with the help of interest rate. So the next one is fiscal policy, and how government achieve the economic objective by the fiscal policy. Let's see. On the other hand, fiscal policy is influenced by government by adjusting the nature and extent of the taxes, government spending and borrowings. A healthy fiscal policy is important to control inflation, increase employment, and maintain the value of the money. On the other hand, when governments and when the government see that there are lots of circulation in the money, high inflation rate, then government reduce the tax rates. And when they see that the lots of money circulation in the country and business are doing well, they increase the tax rate. So with the increase or decrease the tax rate, they can influence the economy. Government can influence the economies, because businessmen decide their business on the government policy, according to the government policy. If the government policies are flexible, relaxable, then they do business, they do more business to increase their profits. And when they see that there is a lots of restrictions by the government, lots of tax rates to do the business, then automatically most of the people do not take decision to start the business. That's why government of UAE decided to not charge any type of tax if anyone come into the UAE and start their business. So you can say the UAE is the tax free zone. There is no tax on the salary, there is no tax on the business as well. So this is the fiscal policy. I give to you one example of taxes. On the other hand, the spending. When government realize that we must spend our share into the economy for the development, for the construction of hospitals, for the construction of universities, educational institutions, and some like these development expenditure they spend in the country. And with the help of spending the policy automatically increases the business, because they give the relaxation to do the business. We have already discussed the taxation and the spending, and now we will discuss these two tools in depth. First of all, taxation. The government has two variables to influence the fiscal policy, namely taxation, regulating which the government increase or decrease the disposal cash in the hands of the public. First of all, first tool is the taxation. And what does this tool do? With the help of this tool, government decide how to collect the cash from the publics, and how not to collect the cash from the public. If government increase the tax rate, automatically more cash amount public should pay. If government reduce tax rate, the public should pay the less amount of the tax. So taxation is the tool to influence the economy of the country. Now next one is this government spending. There are two tools, one is taxation and second one is the government spending. What is the government spending? Using which the government invest in the public infrastructure, works and other social welfare schemes that directly or indirectly influence the state of the economy. Government use different development projects, and ultimately the impact of these development projects goes to whole economy. If government increase to construct the universities, the hospitals, then automatically it increase the facilitation of their public. So what is the government or federal receipts now? First of all, there are two tools of the fiscal policy which influence the fiscal policy, that is the taxation, and the second one is the government spending. Now, what are the sources of federal government to collect the revenue? We have already discussed this topic into the previous video. I think first part of the tax history. If you don't watch this video, you should watch this video to clear the concept of this topic. But now here we will discuss each topic in the depth: the revenue receipts, capital receipts, external receipts, public account receipts. So basically government have the four sources to collect the revenue uh, within the country or without outside the country. So we will discuss these four topics one by one. All of these, except for the public account receipts, become the part of the federal consolidated fund. So this is the very important question, that what is the federal consolidated fund, and which combination of the federal consolidated fund. So you can say, except public account, all the collection sources are the federal consolidated fund. And what is the public account? We see it into the later. Headwise detail of the government: revenue receipt, net of provincial shares. So this is the federal, which means the government revenue. It includes the provincial shares. Okay, in Pakistan there is heavy dependence upon revenue receipts. About 65 to 70% of the revenue is estimated to be drawn from the revenue receipts. It includes tax revenue and non-tax revenue. So the tax collection is the revenue receipts of the government. If someone say ask to you that tax revenue is the revenue receipt or the capital receipts, so understood, the tax revenue is the revenue receipts which collect within the 1 year, not above the 1 year. And I have already made the video that which describe the difference between the capital and revenue expenditure, capital and revenue receipts. I will give the link of this video in my description as well as in the icon button. You can watch this video later on. Non-tax revenue. Oh my god, what is this? Okay, sorry. Tax revenues. In taxes, we have direct taxes such as income tax, indirect taxes such as federal excise, sales tax, and custom duties. So this is the more detail of the taxes. We have basically two types of taxes: direct taxes and indirect taxes, in which direct taxes include, and what are inclusion in the indirect taxes. The indirect taxes include sales tax, federal excise, and the custom duties. And indirect tax comprises the bulk of the Pakistan's total revenue. Okay, this is another important question, that what is the ratio between direct and indirect tax collections. So indirect tax, the tax collection has lots of ratio, near about 70%. Non-tax revenue, it includes income from the government property, enterprises, and receipts from civil administration and other functions. Okay, these are the non-tax revenue. You can say these are the revenue against this revenue government provides some facilities, and when government provides some facilities, obviously they charge for this facility, but not for profit making purpose, only for cost of service. So these are the non-tax revenues. According against this, government provide you some facilities, and you can see government provide lots of facilities according to this, like tool taxes and like educational fees which collect government, but these fees are not for profit making purpose. This is only for recovering the cost. This is the presentation error, this is the mine error. I really sorry to you in advance. Okay, other taxes and surcharges. Surcharges are also a type of indirect tax, but they do not fall under FBR tax revenue. Surcharge on natural gas and petroleum fall under this category. Surcharge, you have already here that the government increased the surcharge and levy on the petrol, which ultimately effect on the price of petrol, which increase or decrease in the whole year. So this is the example of surcharge and levy, and it is not included in the tax revenue. Okay, it is the another head of the government's income. So what is the capital receipts? In previous we discussed the revenue receipts. Now we will discuss the capital receipts. The capital receipts include recovery of loans and advances. We will discuss these topics in detail in the next slides. Here we just look what how many heads in the capital receipts: domestic debts receipt, non-banks; external resources capital receipt; public account receipts. So it is enough for today. In the next video we will discuss the capital receipts, and we will complete this topic. It is enough for today. Okay, if you are new in my channel, you please subscribe this channel, press the bell button, and if you like this video, please press the like button.